And so what happens is that you had 243,000 ounces get delivered in the OTC market in exchange for physical to BRICS, Hong Kong. And what happens then is that once the gold arrives in Hong Kong, the trade is unwound in COMEX, and the bars are then transported by armored truck to the Shanghai Gold Exchange. So again, we've been saying this forever. These people are using the suppression of the Western market against us. They short the price on COMEX. They then purchase the physical at a subsidized price and stand for delivery in Hong Kong and then move it to the Shanghai Gold Exchange. And look at the deliveries off the Shanghai Gold Exchange. They're off the charts. So they're bleeding dry the LBMA and the COMEX, having it moved by exchange for physical to Hong Kong and then driven over by armored car to the Shanghai Gold Exchange where they take delivery. I mean, you can't make it up. And between the Shanghai Gold Exchange, where those purchases are like cash and carry, and the Shanghai Futures Exchange, the combined average daily volume over the past 2 months has increased more than 200%, and it now exceeds the average trading volume of the New York COMEX market. Effectively, that now makes Shanghai the world's second largest gold trading market after the London Bullion Market Association. Little by little by little by little. Do you not see it, you guys? Over 200% in the past few months. Interesting. And it's all exchanged for physical. Interesting. And it just happens to end up at BRICS Hong Kong, which is a COMEX-approved vault. And then it just happens to find its way to the Shanghai Gold Exchange, and the deliveries are off the charts. See the bigger picture? If not, you're going to get rolled over by this when it all breaks. I hope people do. And if you look, China's net gold imports via Hong Kong in March rose about 40% from the previous month. They continue to slowly increase, and the media does nothing to tell us what's happening.
In a recent discussion, financial analyst Andy Schectman sheds light on a concerning trend: the shorting of a crucial asset that could potentially collapse the US economy. With gold and bonds in flux, Schectman questions why any country would hold US debt amidst escalating geopolitical tensions and inflationary pressures. He points out a significant shift in global asset allocation, with countries like China reducing their treasury holdings in favor of gold and oil. Moreover, he highlights the staggering increase in gold deliveries to the Shanghai Gold Exchange, suggesting a strategic move away from Western markets.
Look, what's happening right now with gold and the bonds? Why would any country, like, look at China. They used to have almost $3 trillion in treasuries. They're down to just over $700 billion. Why would any country want to hold any of our debt of any duration when this stuff is happening? When we go around the world imposing sanctions on everyone and now confiscating those assets. And, you know, it's okay for us to do it, but you can't. So, but hey, take our debt, please. We need to build our military because we've borrowed all this money to other countries that we really don't have. But why would anyone want to hold our debt of any duration whatsoever? And the answer is they won't, because we've chosen inflation over austerity. We know that if we raise rates, we blow everything up. If we lower rates and inject inflation and signal that we will never balance or normalize our balance sheet and let the inflation engine run, well, it leads to the same place of higher interest rates. And so the Fed's trapped and they know it. Why would anyone hold these long-term duration bonds? And so, you know, when you talk about the banks, right? Ultimately, I've said for a very, very, very long time that interest rates spike to the moon as people dump our treasuries. Well, it's happening. The little by little by little, it's happening. You can see it. Now, we're supposed to believe that the United Kingdom and Ireland and the Cayman Islands are, you know, next to the Federal Reserve, will be the biggest holders of our debt. The UK is going to pass China here very quickly. And Jim Willey, I love the guy. He's got courage to say things I don't. He says that Ireland and UK and Cayman are being funneled money by the Fed under the table to do this. Because why the hell would they want our treasuries too? They're not dumb. They see what's happening. And to keep the game going a little bit longer, we have a situation where the countries that were always buying our treasuries are now selling them and replacing it with oil and gold, because these are assets that have no counterparty risk and are demanded across the majority of the globe. It's a new system where gold and oil are being remonetized, in my mind, in favor of the U.S. Treasury. You're seeing de-dollarization and de-treasurization. So when you talk about a bank that failed, well, yeah, look at all the 185 banks that you mentioned on Razor's Edge. What will break it? Rates rising. Well, you know, Powell said that his mentor, Paul Volcker was his mentor for raising rates to 18.75%, right? Well, he ain't no Paul Volcker, because he realized that he got, you get to 5% on the 10-year Treasury, you're going to have things start to break. And he's not doing that. So how about the villain theory that I've talked about endlessly? Make people say, what the hell is going on in the United States? And look what they're doing around the world, and they're broke. We don't want it anymore. And besides, they're going green. They don't want to be part of the oil gang. And so besides, all those guys are now joining the BRICS. It's time to go move another way. And all these countries dump dollars. Or they just say, we're not taking dollars for oil anymore. I mean, you can see it. And maybe this is why you're seeing the yen so low, to keep that carry trade going, to keep the dollar strong. I mean, I don't know what the hell's going on anymore, other than to say ultimately I see rates going much higher, because there is no way they can ever normalize the balance sheet. Either the whole thing blows up or they choose inflation. It's one or the other, and there is no other way they can do it. And rates will go higher. What does that mean for the banks? What does that mean for the insurance companies? So yeah, when you talk about the great taking, the risk, and how undercapitalized and over leveraged this whole system is, including the FDIC, which during this banking funding cost the FDIC $667 million. That they only have 1.8 billion in their account, or less than that, backing 18 trillion. So I mean, how many more banks? This is a small one. How many more can fail before, boom? I don't know. Yeah, I think this is a really cool point, and I don't think really anyone's talking about it. Some people are maybe, but I don't see many people. So the other day, right, we saw 7,560 gold kilobars that were shipped out of the COMEX, okay? That's $571 million worth of gold, 243,054 ounces. Who's got that kind of bread, right? So it was all shipped through to Hong Kong BRICS. The exchange for physical is a way where you can buy a contract on the COMEX and exchange it for physical, typically in London. But if it's done in the OTC market, the over-the-counter, the two participants can negotiate and say, I'll take it here. And they can even negotiate, I believe, in the form of the gold. You want gold eagles? Fine, we'll deliver it there. But anyways, the OTC is, in respect to BRICS in Hong Kong, almost all of the, and this is a COMEX approved vault, right? Almost all of these transactions that go to Hong Kong BRICS are OTC, right? Almost all of them, or excuse me, exchange for physical, almost all of them, right? And so what happens is that you had 243,000 ounces get delivered in the OTC market in exchange for physical to BRICS Hong Kong. And what happens then is that once the gold arrives in Hong Kong, the trade is unwound in COMEX, and the bars are then transported by armored truck to the Shanghai Gold Exchange. So again, we've been saying this forever. These people are using the suppression of the Western market against us. They short the price on COMEX. They then purchase the physical at a subsidized price and stand for delivery in Hong Kong, and then move it to the Shanghai Gold Exchange. And look at the deliveries off the Shanghai Gold Exchange. They're off the charts. So they're bleeding dry the LBMA and the COMEX, having it moved by exchange for physical to Hong Kong, and then driven over by armored car to the Shanghai Gold Exchange, where they take delivery. I mean, you can't make it up. And between the Shanghai Gold Exchange, where those purchases are like cash and carry, and the Shanghai Futures Exchange, the combined average daily volume over the past 2 months has increased more than 200%. And it now exceeds the average trading volume of the New York COMEX market. Effectively, that now makes Shanghai the world's second largest gold trading market after the London Bullion Market Association. Little by little by little by little. Do you not see it, you guys? Over 200% in the past few months. Interesting. And it's all exchanged for physical. Interesting. And it just happens to end up at BRICS Hong Kong, which is a COMEX-approved vault. And then it just happens to find its way to the Shanghai Gold Exchange, and the deliveries are off the charts. See the bigger picture? If not, you're going to get rolled over by this when it all breaks. I hope people do. And if you look, China's net gold imports via Hong Kong in March rose about 40% from the previous month. They continue to slowly increase, and the media does nothing to tell us what's happening.
Continuing his analysis, Andy Schectman delves deeper into the global implications of the ongoing repatriation of gold reserves from the United States. Highlighting the recent withdrawals by several African and Middle Eastern nations, including Nigeria, South Africa, and Saudi Arabia, Schectman underscores the erosion of trust in the U.S. Treasury market due to perceived counterparty risks. As these countries move to reclaim their gold reserves, questions arise about the stability of the current financial system. The accelerating pace of these developments suggests a seismic shift in global economic dynamics, with implications for investors worldwide.
When we go way back to the beginning, when you and I started talking several years ago, we talked about the bleeding dry of the New York Fed by the Eastern European banks, right? The German Bundesbank, Bank of Turkey, Hungary, Czech National Bank, Bank of Austria, Bank of Poland. They all said, give us back our gold. And they're the ones that went on the big buying spree, right? Well, now, because of the weaponization of assets and the weaponization of the dollar and the treasury market, you know, I think it was Representative Mooney who asked the Fed for who's taking all the gold, who's repatriating all their gold. And even through the Freedom of Information Act, they didn't answer, at least to my knowledge. But I just read an article, and I'll read a little bit of it here too. Several African and Middle Eastern nations have begun withdrawing their gold reserves from the United States in recent months. Nigeria, South Africa, well, that's interesting. Those are BRICS members. Well, Nigeria applied and an OPEC member. Ghana, Senegal, Cameroon, Algeria, Egypt, and Saudi Arabia, each representing crucial regions in Africa and the Middle East, to withdraw their gold reserves from the New York Fed. And so this is about counterparty risk. Again, why would you trust? This is trust, and we have squandered the trust. And that's why you're seeing countries sell treasuries, and that's why you're seeing all of these countries, and all of them are going to apply to the BRICS or in the BRICS or on the Belt Road. Every one of them says we're the next target. So let's slowly get our stuff back. Let's slowly extricate ourselves from the treasury market. I mean, you can see this happening, and it's all put all of these things together that we've talked about today in a bigger context, and then look at it. And this is where Occam's razor comes in. This is where I try to follow this linear path, but the more stuff I see, it just is shocking to me that how fast it's accelerating. And when you see Saudi Arabia and Egypt just happen to be new members to the BRICS, repatriate their gold from the Fed, and you can see the amount of treasuries they're selling and the amount of gold they're buying, you don't have to be a rocket scientist to see those crumbs laid at your feet, and where do they lead to?
Today's discussion has uncovered critical insights into the shifting dynamics of global finance. We've witnessed the erosion of trust in traditional assets like U.S. Treasuries and the strategic moves towards gold and oil. With countries repatriating their gold reserves from the New York Fed and the surge in gold deliveries to the Shanghai Gold Exchange, the signs of a paradigm shift are undeniable. Remember to stay informed and engaged by subscribing to our channel, liking this video, and sharing your thoughts in the comments below.